So I'm Manoj, and by qualification, I'm chartered accountant, qualified in year 2005, having 20 years of experience in the investment banking and valuation profile. Uh, so about my career, I started my career with Moody's Analytics in year 2005, and then I joined Goldman Sachs in the investment banking division. After this, I worked with a private equity fund also. And since 2009, we are into this domain where we are training candidates on the investment banking and the valuation side. Guys, the basic purpose of, starting Wall Street School in year 2009 is to impart practical side of, training on the valuation and the investment banking side. Uh, Basically, when we started our career, me and Himanshu, in the investment banking domain, we found there is a huge gap, in the practical skill set which is required on the in the core finance profile and what we learn, in our degree. So that's what the purpose of, this training. And so far, we have delivered more than 300 batches on the valuation side. We are also exclusive training partner with Economic Times, where we deliver valuation session on stock market and equity market. So guys, let's start. And because this demo session is only for 1 hour, so I'll try to cover a part of the valuation side, which we can all, comprehend. I'll not go into very complex topics today. Okay. So let's start. Okay, guys. So first of all, before we, discuss this topic valuation, let's quickly understand why valuation is required. So, valuation is required if you want to find a fair value of any asset, any class of the asset. It is not just related to the equity or maybe the bond market. It is related to any class of the asset, maybe real estate. So every time you want to find a fair value of any asset, you are supposed to do valuation, right? Now, why valuation is so relevant in the corporate finance domain? Because as a banker, as a equity research analyst, you always look to find best priced stock, best priced company, fairly priced company. And as a fund manager also, if you're managing portfolio of your clients, then obviously you will look for the companies or the stocks which are underpriced or fairly priced, right? You will not like to invest into those companies which are already overpriced. So we do valuation in almost all domain of investment banking, whether it is M&A advisory or it is equity research, equity research, okay, or it is fund management. Now, how these three domains are different, and there could be many more domains, guys. But primary domain, if I discuss primary segments of the market. Now, mergers and acquisition. Mergers and acquisition is related to, when you advise your client on buying or selling the business, right? So if you want to buy any other company or if you want to sell your existing business, you have to find the fair value, right? So valuation plays an important role here, right? It's all about valuation. It's all about, meeting expectation of buyer and seller, right? If buyer expectation is different from the seller's expectation, deal will not happen, right? Same goes with equity research. So in equity research, as an analyst, your job is what? You have to give, your fair estimation of the stocks which are trading in the market. So you might have seen research reports initiated by Goldman Sachs, Jeffries and all, where they give target price on the stock. So these target prices are what? They are based on fair valuation of listed companies in the market. So they arrive at the fair value, and suppose, for example, Reliance Industry. Reliance is currently trading at say 1400, and as per Jeffries, fair valuation is say 1800, right? So that would become my target price in my research report. So as a research analyst, I'm supposed to do fair valuation of listed stocks. Same goes with fund managers. So what's the job of fund managers? Fund managers basically, they do research on the stocks and they deploy your funds on behalf of you in the various classes of assets and various stocks, right? So they also need to arrive at fairly priced stocks or underpriced stocks. Then only they will be able to beat market return. Okay. And likewise, guys, there would be various other domains like private equity funding. When you are on the PE funding side and you're putting your investment into private companies, you have to arrive at fair valuation. So this valuation is required in various segments of market and corporate finance. Now, when it comes to valuation, guys, valuation of equity, then the question comes, what are the methods? How do we arrive at fair valuation, right? So normally what happens, like, if we invest into the market as a retail investor, we simply look at, YouTube channels or some Instagram reels, and somebody says, okay, Tata Power stock is going to give you 60% return, 70% return, or it is going to double in next 6 months. Now, we don't try to understand what's the basis of his or her recommendation about Tata Power. Why they are saying that the Tata Power will become double, right? Because ultimately there should be value, right? So valuation will give you this answer whether this particular stock is good to invest or not. And guys, in the stock market, take my mark my words, long term, only valuation will give you return, right? See, random, stock tips and all can give you return in the short term. Maybe some stocks you bought on the basis of some random tips, and it give you 5-10% return in the short term. But it's not a long term game. Many time you will see these recommendation, these tips, they does not live up to the, you know, uh, expectation of the investors. Reason being there is no research behind it. And when there is a research, so yes, when equity research firms gives you those stock tips, not tips, but they give you thorough research about particular stocks, and they give you fair valuation, target price on the basis of those research, right? So these fair valuation arrived at by the equity research analyst is based on valuation, right? Now, how this valuation is arrived at, what are the methods? Guys, there are two broader methods to do valuation of any company, and these are the universal methods, right? Whether you are on a PE equity, private equity side, whether you are a fund manager or you are equity research analyst or you are an M&A advisor, you are supposed to deal with these two methods of valuation. And what are those methods? Methods to value. So guys, first method of valuation is called relative valuation. Relative valuation technique. The second method of valuation, any guess about second method? Method number two? Any guess about the second method?
Income
Yeah.
approach.
Right. Discounted cash flow. This is also called intrinsic valuation. Now, before we get into details of these methods, let's quickly understand basic difference between these two methods. How these two methods are different. Guys, see, relative valuation method, as the name suggests, this method is based on comparison. It's a comparison based valuation. Relative. You try to find valuation by relating your company with other companies which are already priced. The best example of relative valuation is if I relate this with a day to day, our example of valuation. See, when it comes to the real estate valuation, say if you want to buy a property, right? Now, if you want to buy a property, you first have to locate the property, right? In the area, in the target area where you want to purchase this. And then you have to find the fair valuation of this property. And normally, when it comes to the fair valuation, we look at the market price, market prices of other properties, other similar type of properties. For example, I'm planning to buy an apartment in Gurgaon Sector 79 in a particular, locality. Say I'm planning to buy an apartment in Godrej area, Sector 79. Now I'll look at how at what price other apartments in the same locality they were transacted in the past, right? So in this case, the common metrics what we compare is price per square feet. What's the current price per square feet? At what price per square feet other properties were transacted in the same locality? In this case, guys, we are trusting market conditions. We are trusting how other properties are priced in the market. That's the right and fair method of valuation. And the market is doing complete justice when it arrive at this price. For example, when I look at the past properties, I got 5 transactions in the same locality in the last 6 months. And this is what the name of those properties, I just to differentiate. And I got to know that the property A was sold for 12,000 rupees per square feet. This is the common parameter, right? Because I cannot compare the total price. Different properties might have different areas. So we normally go with price per square feet. So property A was sold for 12,000 per square feet. Property B was sold for say 11,500 square feet. Property C was sold for 12,500 square feet. And property D was sold for say again 12,000 per square feet. Property E was sold for say 11,000 per square feet. Okay, so I can see in this area, the prices at which these kind of properties were sold in the past were in the range of 11,000 on the lower side and 12,500 on the higher side. And if I take an average price, the average price will come say 11,800. If I take an average of all five. Now this 11,800 will tell me the market. So this is what the market benchmark. And if I want to find a fair value of my property, which I want to buy, say my property is say property F, which has an area of 1,000 square feet. Now I want to, this is an area, okay? This is an area of the property, size of the property. Can you tell me fair price of this property? What's the fair price? Anybody? What's the fair price of this property? I'm waiting.
11,800 or anything less than that.
11,800 into 1,000, basically.
Oh, sorry.
11,800 is the per square feet price, right? This is what price of 1 square feet. And your area of the property is 1,000. So fair price of your property is 1,000 total area multiplied by 11,800. That would be 1 crore 18 lakh. So here, guys, what you have done, you've simply looked at other properties which are already priced in the market, and that those other properties have become basis of your valuation. That's a simple technique of valuation and which is called a relative valuation. Doing valuation by relating prices with other properties, same class of assets. Guys, same technique is applied in the equity market also. I'll show you how, and we'll make some adjustments here. I'll give you some very simple example here, and I'll show you real market data, how this technique works in the market. Now, guys, under this technique, you're completely relying on the market. You are just assuming that the market is fair in giving valuation to individual properties, and that's why your basis of valuation is just market. Market may be overpriced, market may be underpriced, but you are trusting the market consensus, which is an average, right? Now, about this second method of valuation, guys, which is what? Second method of valuation is discounted cash flow technique. Now, DCF valuation is slightly different from the market-based valuation. The first technique is market-based valuation, but the second method of valuation is DCF. Full form of DCF is discounted cash flow technique. Again, guys, as the name suggests, right, this entire valuation is hidden in the meaning of this name. If you just explain this valuation, this DCF, you will get the answer what this DCF is. So what this method is saying, you need to project cash flows of the company. You are supposed to project what cash flows business will earn from now till the business will remain into existence. For example, I want to find DCF valuation of Reliance Industries, right? If I want to find DCF valuation of Reliance Industries. Now, this method says you're supposed to first estimate. Because, guys, see, if you're buying a stock of Reliance Industries or if you want to value Reliance Industries today, you are concerned with how much cash flows this business will return back to the equity investors in future, not in the past. Past has already been, past cash flows has already been accumulated in the company. It has been distributed as a dividend or invested in the capex assets of the business, etc. But when I'm buying a stock of the company, I'm concerned about how much cash flow business will earn in the future, right? So if I'm supposed to do Reliance Industries DCF, my first step one, would be estimation of estimation of what? Estimation of what? Cash flows. Estimation of cash flows, what Reliance Industries will earn in the future. Now, can you please answer me? For how many years I should estimate these cash flows? For how many years Reliance Industries will remain into existence in future? What should be the time frame for this estimation? Next 10 years? Forever? Infinity? Yes. Guys, not 10 years, not 5 years. It should be estimation of cash flows for infinite period, because the Reliance Industries is not gonna to end its operation in next 5 year or 10 year. So the basic assumption about any business is going concern. Going concern means it will remain into existence forever. It is not going to end its operation in next 5 year or 10 year. So we have to do estimation of the cash flows for entire life, right? How we'll split this period, that's a part of the detailed process of DCF. Now, once you have these cash flows, suppose, so we are not getting into this estimation part, but suppose you have these estimation starting from year one, year two, and going up to year infinite, right? You have those cash flows. Now, guys, these cash flows, suppose I'm just taking random numbers here, 10,000, and obviously a business, so you will see that every business grows, right? So the cash flows will also increase. So suppose this is how the cash flows are growing. Now, what these cash flows are, they are saying that these businesses, this Reliance industry will earn this much of cash flows for its investors in future. Now, guys, you need to value Reliance Industries today. Today means today, as on date. Would you give this valuation sum of all the future cash flows? Can a seller of this company or seller of equity of this company demand you, okay, give me all the cash flows ka value, what you will get in the future from this company? Would you ready to pay sum of all the future cash flows? The answer is no. You will simply say, boss, these cash flows will happen to me in the future, right? This will happen to me after year one. This will happen to me after year two. So I'm not getting these cash flows today. So you are supposed to discount these cash flows. You are supposed to discount all these cash flows to present value, right? You're supposed to discount all these cash flows to the present value. And for discounting these cash flows, you're supposed to calculate discount rate. At what rate you will discount, right, guys? And that's why this is called discounted cash flow technique. You have to discount all the future cash flows to the present value. Very simple. But the only difference between DCF and relative valuation, guys, see, in relative valuation, I'm not doing any projections of infinite years, cash flows, and all. I'm simply trusting the market. I'm just relying on the market conditions, and I'm assuming what market valuation market is giving to other company is the right valuation. In discounted cash flow, this estimation is done by whom? Who does this estimation, guys? Who does this estimation? Who calculate discount rate? How you will get this estimation? The person who is doing this valuation, right? The person who is doing this valuation means analyst. Yes, right. Who will do these estimation? Analyst. It means, guys, there is a basic difference between DCF valuation and relative valuation. Relative valuation is based on the market. You're just trusting the market. And in DCF valuation, you are not trusting the market. You're trusting your own estimation as an analyst, right? So analyst view about the company is the main basis of valuation here. If you're bullish about the company, your valuation is going to be on the higher side. If you're bearish about the company, your valuation will be on the lower side. Right, guys? Now tell me, in the short run, if you're investing in the market, in the short run, which valuation will play an important role? DCF or market-based valuation, relative valuation? In a short term, I mean, maybe for next 2 years. So for market, short term is not just 3 months, 6 months. Short term maybe 2 to 3 years to maybe 5 years also. Relative approach, right? In short term, relative approach will play an important role, guys, because that's a market condition based valuation. So market look at other companies' pricing. And in the long term, very, very long term, guys, which method will play an important role? Suppose you are investing in a company for 20 years, 30 years also. DCF, right, guys? So you might have seen, portfolio of Warren Buffett and all the successful investors. And have you seen that do they churn their portfolio like quickly in the market? The answer is no. They invest into company for the very long term. Warren Buffett use DCF valuation very extensively, right? He want to see the intrinsic value of the business. So for him, if Reliance Industries intrinsic valuation, suppose DCF value of Reliance is coming, say, 1900, considering all the future cash flows, and the current market price is what, 1400, there is clear cut undervaluation. The stock is highly undervalued, and he will pick up the stock and will not, so he will not be worried about short term correction in the stock price. He knows there is a long term value in the stock, and he will remain invested in the stock till the time the stock price does not surpass the fair value. Right, guys? So this is how these two methods are different: DCF and relative, analyst assumption based and market based, market condition based. Right, guys? So with this small overview of the methods of valuation, I'll just quickly give you an example of relative valuation. I'll take it from the current market, right? And I'll show you how this relative valuation plays an important role in the market in deciding the pricing of stock in the market. So guys, let's understand this with an example here. So this part we have already discussed how relative valuation works. It works based on how other comparable companies are priced in the market. So it's purely based on comparison. But how it works, I just give you an example here. See, guys, I've taken example of IT companies and I've divided these IT companies into two parts. Large cap companies, you can see my first segment of IT companies, five companies: TCS, Infosys, HCL, Wipro, right? These four companies are part of large cap because they are part of index, and top 50 companies may they come. Next set of companies are medium-sized companies in the IT space, right? So in this, we have Mindtree, Tech Mahindra, Persistent System, Coforge, right? All these eight companies are well-known companies, and most of you would have been aware about these companies, right? The business model and all, right? You can see, guys, this thing is also evident from the market cap. TCS is the largest IT company, having a market cap of 11 lakh 23,000 crores. Infosys is next largest company, 6 lakh 39,000 crores, and so on and so forth. My smallest company in this comparison is Coforge, which is having a market capitalization of 60,500 crores. Right, guys? But that's not my comparison. In the next column, you can see I have price per share updated till 12th of November. So I did not update this yesterday's closing. I updated this day before yesterday's closing. And these are the prices. Okay. You can see these are the prices. Now, guys, can I compare these prices in absolute terms? If I want to find out one of these companies to invest, can I compare these prices and find, okay, which company is good to buy? Can I do this comparison? Can I apply a relative approach by comparing these prices? Yes, right, Pankaj. We cannot compare these absolute prices. Reason why we cannot compare these absolute prices, guys? Deepak, why we cannot compare these absolute prices? What's the issue? Because, guys, different, no, not number of shares, guys. These prices relates to different size of earnings. All companies are not giving you same earnings, right? So when you invest into stock of the company, what you get in return? Earning per share. What you get in return? EPS, which is called EPS, right? Earnings per share. And all companies are not giving same earning per share. There's a difference. For example, in case of properties, one property is of 4 crores and other property is of 3 crores. There is no comparison unless until you convert these prices of property into price per square feet. You divide this price of properties with the area of the property, right? To standardize the comparison metrics. So same goes with the companies, guys. Maybe Infosys is giving you, TCS is giving you higher EPS than Infosys. Can you see the comparison here? If I just compare, just like a layman in the market, the first time who is investing in the market, he will simply, these people search stocks like this. They will say, okay, I'll invest into Wipro because it is lowest price stock. And even if they are supposed to compare between TCS and Infosys, he will say one price of Infosys is 1500, whereas one share price of TCS is 3000, double. So I'll invest into Infosys because I'll get more number of shares here. That's wrong approach. So we are first supposed to convert these prices into standardized metrics. So that thing is evident from here, guys. If the market is giving double price to TCS compared to Infosys, both companies are fundamentally same, guys, right? Both are IT companies, both are exposed to the overseas operations and all. Still, TCS is having double the price compared to Infosys, and the reason is here. Can you see earning per share of Infosys versus TCS? TCS EPS is almost double compared to Infosys. So there is a difference in the earnings also. So how do we compare this price, guys? The answer is here. You will calculate very simple this is one of the simplest multiple, guys. There are many multiple we compare in relative valuation, but one of the very simple multiple. I'll show you one more multiple how we can compare other type of companies, but here I'm comparing very simple multiple here. Price to earnings, yani price divided by EPS, so that we can neutralize impact of difference in the EPS, right? Now we can see, guys, what price market is charging against 1 rupee of EPS for all companies, right? Can you see any difference, significant difference in TCS and Infosys pricing, guys? Do you think market is giving too much premium to Infosys or TCS compared to other company? Is there any significant difference? No. There is no significant difference, guys. Almost same. Market is just focused on EPS. If EPS will grow, price will grow, right? So even you look at HCL, again another large cap company in the IT space. Do you see any significant difference here? The answer is again no. 24, 23, guys, this is what the pricing market is giving to the large cap IT companies. Now, guys, can you see Wipro? If I am supposed to select one of these four large cap company, one of these four large cap company, which stock you would invest? Would you invest into TCS, Infosys, HCL, or Wipro? Which stock is good to invest? Which is gonna to give you higher return in the future? HCL, Wipro. I got most of the answer Wipro, and the Wipro seems to be correct as far as this information is concerned. Though I'll share some more perspective here, but as of now, if I am assuming no difference in the fundamental size, right, guys? If I'm saying all the companies are fundamentally same, they're good, then obviously the right answer is Wipro. Right answer is what? Wipro. Because here I'm paying just 19.6 rupees per 1 rupees of EPS, right? So cost what I'm paying for Wipro is less than other companies like HCL, TCS, and Infosys. But guys, if I'm supposed to select one of these four companies, right? I'm not comparing large cap with the mid cap as of now. But if I'm supposed to invest in one of these four companies, which company is good to invest? And which company is not good to invest? Rather, let me reverse my answer question. Which company is the highly overpriced, which you should avoid, which is gonna to correct when the market will correct, so it will correct more in the smaller segment. Coforge, right? It makes sense, right? Coforge is most overpriced company. It seems to be most overpriced. And this seems to be most underpriced, right? Now, guys, when you compare stocks like this, see, the most underpriced stock is Wipro and most overpriced stock is Coforge, right? It seems to be. But your analysis is gonna to change. You're just looking at the 50% of the picture of this valuation, guys. When you compare, so okay, you are better than those people who just invest into stock based on the random tips, right? Now at least you're comparing price with the fundamentals, right? You're comparing price, what you're paying, and what you're getting in return EPS, right? Now when you're investing into stocks like this, there are chances that you can commit a mistake here. Now, what could be the mistake? I'm doing everything right. Everything seems to be correct, and it seems like Coforge is highly overpriced. Have you tried to find an answer why these next four companies, right? These four companies are so much overpriced compared to the first four set of companies. What could be the possible reason, guys? Why market is giving so much high valuation to Coforge? Is it because the stock is overpriced or some other reason is behind this? Good potential. Perfect. Yes, right, Deepak. There could be a good potential in the business. It means Coforge could be expected to do better than other peers in the future. What they are earning as of now, yes, on the basis of this, it seems to be overpriced, but the market has lots of expectation from this stock in the future. But guys, how do we factor that expect? It means every company is fundamentally different. Just understand, all the companies in the market, in the though they are operating in the same industry, they could have some fundamental differences. There could be difference in their potentials. How do we factor those potentials in my comparison? How do I factor? Yeah, right, Ankur. Market is giving premium for the future growth. I understand. But now it means my comparison of PE does not make sense then. That comparison of P is not making any sense because the market is giving different P multiple for different growth potential companies. Now, guys, to understand this point, let's move to the Excel part. I have same calculation in the Excel. Okay, and guys, in this, I'll also give you one tip, not tip, stock tip, but basically, I'll uh, tell you the basis, stock database, which we can use for the future, measurement of future potential. Okay, so we'll discuss this part also. Now, guys, you can see the same comparison I have in this spreadsheet. Okay, I'm comparing first four large cap companies and next four mid cap companies, same P multiple, and it shows that the industry P multiple for large cap companies are it is 23.7. It is an average median basically, right? And for mid cap companies it is 53x, which is on the higher side. So if I just look at the overall industry segmentation, it seems like the market is giving higher valuation to the mid size IT companies compared to the large size IT company, right? This is the large size. The only reason I can figure out here, it seems like small cap companies, mid-sized companies have more growth potential. That's why the market is ready to pay a premium for those companies compared to large cap companies because they are the saturated companies. So market don't see much growth in TCS, Infosys going forward. There would be a normal growth, right? Now, what I did, guys, I just took an estimation of their EPS for 2028. So currently it is, so as of now, I've taken, the current EPS is coming from March 25, the last year reported numbers. And you can see, guys, my estimates are for March 28. There is a gap of 3 years. I've taken next 3 years ka estimate. Okay. Now, you can see, guys, how EPS of TCS will grow in the future. It will grow from 134 to 164. And the average growth per year, this 7% is what? CAGR, compounded annual growth rate, yearly growth, right? So 3 years ka growth it could be 25, 23, 24%, but yearly growth is coming 7%. Now, if I look at Infosys, Infosys is also expected to grow at the same percent, 8%. I'll show you the source of these estimates. Don't worry. These estimates are not random estimates. They are coming from the authenticated source. Okay, I'll show you the source which you can also use when you're doing analysis of the stock. Now, guys, you can see Infosys, TCS, and HCL. Do you see major difference in their growth? Is there any major difference in their growth? Future growth? It seems to be in the similar line, same line. That's why, guys, the current P multiple is also in the almost same range. Wipro is expected to grow at less than the industry average growth rate, and that's why market is giving you lower P multiple to Wipro. And guys, if you look at the small cap companies, can you see growth rate of Mindtree, Tech Mahindra, Persistent, Coforge? Which company is expected to grow at a fastest rate out of these three, four companies, or maybe out of eight companies, including large cap and small cap? Which company is expected to grow at the fastest rate in the future? The highest growing company would be Coforge. And guys, can you see? Can you see why the market is giving you highest P multiple to this company now? Because the expected growth is 38%, which is the highest growth in this industry, right? So guys, it means current P multiple is reflecting current earnings. Yes, it is because price divided by earnings, but at the same time it is also reflecting how this earning will grow in the future. It means it is also reflecting impact of future growth in this earning, how this earning will grow in the future. And guys, that's why we have another multiple here. So I'll do the refinement of in this P multiple. So what I'll calculate here, PEG multiple. So P has just two component, price and earnings, and PEG has three component. So what are these three component? Now here price is compared not just with EPS, it will also compare with growth also, right? So how this PEG multiple is calculated, guys? How this PEG is calculated? Yes, price earning to growth. Now see, guys, if how this PEG is calculated. P multiple, we have already divided price with EPS. Now I'll further divide this P with the growth. And obviously, because growth is into percentage, you have to multiply this growth with 100. Okay. So you will just divide this PE bracket in bracket growth into 100. Always growth into 100 because percentage you have to convert into numbers, right? And when you convert these multiples into PAC, guys, result is totally different. Small cap companies which were looking overpriced, rather they are underpriced. Can you see? Can you compare these PAC multiples? Now tell me, are these mid cap companies overpriced in the market or they are underpriced? If we discount all the future growth potential. Do you see? Are they overpriced or underpriced, guys? Yes, they are rather underpriced, guys. And if I'm supposed to invest based on this growth potential, because now I've discounted my potential growth also, I would rather invest into either into this stock or into this stock. I'm not giving you any tip here, not advice here, but I'm just telling you my opinion, personal opinion here. कि how I select. So if I don't want to get into DCF where I totally depend upon the future growth. I discount entire future growth into my valuation. But in the relative valuation also, we can discount this growth part, right? So if I'm supposed to select a stock based on my fair valuation, right, I'll say, okay, maybe Tech Mahindra is going to create more value for the shareholders in going in future because it seems to be underpriced. See the growth potential and see the multiple, guys. Considering the 20% growth, none of the large cap companies giving you such growth, right? And the multiple is pretty close to that, right? 24, 25. So I'll rather pay a slightly expensive one because the growth is there. So if I discount this growth into PAG multiple, you can see this comparison is giving you better result, right, guys? So guys, this is what use of PEG multiple. This is just a very simple example of how the fundamental difference is, because all 8 companies are fundamentally different. Why they are fundamentally different? Because there's a difference in their growth potential. Different companies are expected to grow at a different rate. So how we can factor these fundamental differences in their PEG multiple? Right, there are other multiples also, other type of multiples and other type of techniques also, and the factors also which we neutralize with the multiple comparison, right? So guys, now the question is, how do we get this estimated EPS? Because that's, is it coming from the analyst side? If it is coming from the analyst side, then it is biased, right? If so, I can decide any growth number here, and that would be biased. Market does not rely on those my individual estimates. So guys, these estimates are not my individual estimates. These are basically market consensus estimates. These estimates are what? Market consensus estimates. Who will tell me what is market consensus estimates? Any idea? Who will tell me? Yes, we can find correct price to buy also. So based on the PAG multiple, we can see, okay, which stock is underpriced. And if I see, okay, 1.5 PAG if I'm paying for this, and I'm assuming that this stock can reach to the industry average, then there is a potential of increase of at least 50%. Can you see, if I'm buying a stock at 1.5 PAG and the potential is, this has a potential to go up to at least industry median. I'm not saying it will reach to the top of the industry. Then there is a potential to expand this valuation by at least 50% from the current base, right? To answer your question, admin. Yes. So market consensus is what? Yes, all brokers report, Ankur, but it's not just individual brokers report. So we can rely on this market consensus. I'll show you the base for that first, and then I'll show you, how these market consensus are arrived at. So, guys, market consensus estimates, basically, it's not an individual broker's estimate. So you can say, okay, individual broker can be biased. Say Jeffries might be more bullish about, say, Bharti Airtel compared to maybe Goldman Sachs, Morgan Stanley. So it's not about individual estimates. Market consensus is the median estimates of all broker community. Brokers means research reports, guys. You might have seen research reports where you will see the estimates for the coming 3 to 5 years. So all the brokers community. Now this brokers community includes, guys, various reputed brokers also, right? Now, how do we get these estimates, and how do we know how many brokers are covering this company? Because more the brokers covering particular company, better would be idea of this consensus, because ultimately depends upon how many brokers are covering. If your median is based on just 3 brokers estimates, then there could be a good chances of biasness of this median, right? But if this is based on 50 brokers estimates, then good chances that these consensus are actually market consensus, and which market rely, right? So market assumes, okay, but see, guys, you have seen when the company comes out with the results, quarterly results or annual results, right? So when results are out, then it says na, it has, results are as per the expectation of the market, results are above the expectation of the market, results are below the expectation of the market. If results are as per the expectation of the market, stock does not move much. Slight, up and down you will see in the stock in the short term, but in long term it will settle down. But if the results are below the expectation of the market, what happens? If the results, when the company reports its earnings, and if it is below the expectation of the market, what happens to the stock price? क्या होगा stock price पर impact? It will go down. Yes. Now the market was expecting something else and the stock could not deliver that return, guys. So these market consensus are taken seriously by the market. Now, how many brokers? I'll just show you from where to get this consensus estimates. Guys, for this, you can use this database called Market Screener, not Screener. Screener does not give you estimates. Market Screener. You can note down this domain name, Market Screener, guys, and limited data you can search on this Market Screener without any subscription, right? So if you want to do extensive research, say 10, 20, 30 companies a day, then you have to buy this subscription. Otherwise, say 5, 10 companies on daily basis, you can search on this database. I show you how. So this is what Market Screener. Now I want to search estimates for say let's pick any of these companies, right? Let's pick estimates for TCS, okay? So I search TCS here, Tata Consultancy Services, okay? I'll go to the, so can you see guys, they are giving you TCS ka market price at the top, quotes and all summary, etc. Financial tab is also there. Now under financial tab, can you see this analyst forecast? Just click on it. And the moment you click on it, guys, you just need to scroll down a bit. And can you see in the first table, they're first giving you last couple of years actual numbers. Can you see that? These are the actual numbers. Can you see? 19, 20, 21, 20. So company has reported numbers till 2025. And after this, they have given you estimates for next 3 years. The section which is highlighted with the green color, right? So they're giving you estimates for next 3 years. Now, I need estimates of EPS, right? So EPS you will find slightly below, right? So here they have given you this table up to net income. EPS is what? Net income divided by number of shares. So for EPS, you have to come down a bit where they are giving you per share. Yeah, items per share. Can you see this last table? Now, if you check the EPS, last reported EPS was 134. That's the actual number. That's not estimate. But in year 28, this EPS is expected to reach to 163.6 as per market consensus, as per all the brokers covering this company. So this one, so you can see guys, 134 is my last actual EPS. If you expand decimal points, so you'll get the exact number here. And after 3 years, my EPS number is expected to reach at 163.6. You can see. And growth is coming 7%. Now, if you want to see Coforge ka EPS, you can also see. Now, how many brokers are covering this company? How do I know this, guys? How many brokers, estimates are considered here? Come to consensus tab and just click on analyst opinion. Here you will see the target price, right? And how many brokers are covering? If you check the second chart, evaluation of target price of, so they are giving you target price in the past and the future also, how the target prices are changing by the brokers community. So if you place your cursor at the tip of this line chart, can you see the target price range is 1950, right, to 4680. The median is 3470. So the most reliable is the average target price. What's the average target price? 3470, right? How many brokers are covering this company? How many brokers are covering this company? Can you see that? Who will answer this? How many brokers are covering TCS? 44. Yes. 44. It's not 44. It's 45, guys. 44 plus 1, 45, right? And based on the 45 brokers, the average target price where the majority of the consensus lies is 3470, right? Current price is 3100. So at least if I go with the majority of the broker's target price, it is expected to reach at 3400. And their estimated target price, financial estimates are these. So these estimates are not individual brokers' estimates. They are based on the median of all the brokers. So guys, this is what source of my estimates. Okay, they are not biased. They are just based on all the brokers estimates. Okay. Is this clear to everyone? How to source these estimates? Any doubt here? Great. Now, guys, I'm going to take one more example here where P multiple does not work and how other multiples works in the market. For example, if I'm supposed to compare, say Zomato, right? And Zomato, who is the best competitor of Zomato, which is listed in the market? Best comparable company for Zomato, Swiggy, right? They are the clone company. I can say they almost same business model and all, right? So, guys, if I want to compare Zomato with Swiggy, right? Then Zepto, Ankur is not separately listed, right? It's a part of these larger group, right? Swiggy, I suppose, right? So now, if I'm supposed to compare Zomato, guys, can I compare P multiple of Zomato? Can you guys see what the P multiple of Zomato versus P multiple of Swiggy? Can you check this P multiple? It is available on a various market portal also if you don't want to calculate. It is available on Money Control, Google Finance and all. And I can show you, say if I check this P multiple here also. Yeah. So if I search on Market Screener also, say Zomato ka legal name is Eternal, right? And if I click on it, see guys, at what P multiple this stock is trading right now? 507 times. Currently, when we were comparing Infosys, TCS and all, the multiple was, 24, 25 for the large cap companies and for the mid cap size companies was 60, 70 also. But here, can you see the multiple of Zomato? 507 times, right? Now, if I compare this with Swiggy, for Swiggy, it is negative. It means it's into losses. So guys, do you think these kind of companies are measured or valued on the basis of P multiple or compared on the basis of P multiple? Do you think P is the right benchmark multiple to compare these companies valuation? Yeah, Ankur, it is because they have not showed any earnings because still the company is into losses. But the thing is, if the companies are into losses, if the industry is in industry, most of the companies are into losses. Can we compare price with respect to earnings? The answer is no. Market is not much concerned about earnings. Market is more concerned about their top line because these are the companies which are into new businesses, niche industry, right? It is basically those companies which is uh yeah, so basically guys, these companies are not valued by the market on the basis of earnings. They are valued on the basis of their sales number, but the market thinks these companies are new in the market and as the future in future, these companies are able to grab more sales, more market share, earnings will eventually follow. Even if you look at the example of say Amazon, right? You will see many years Amazon was trading at a negative P multiple or at very high P multiple. Company was into losses and still the valuation was skyrocketing. The thing is, these companies are not valued on the basis of earnings for the time being. In the future, yes, these companies will also looked at, valuation will be looked at or judged at the basis of valuation earnings, but not right now. So, guys, what I did, I just compared top line of these companies. Now, what EV is, just to give you a brief about this, EV is basically value of entire firm, not just equity. So when we talk about sales, though we discuss this part very much in detail in relative valuation, enterprise value is the broader valuation of the company, which includes other source of capital also, debt and equity both. So normally when we calculate P multiple and all, we are just focused on equity part of the business. But EV is the total part of capital, which includes equity plus debt both, right? So here, when I compared price to earning multiple, can you see very high P multiple, which was evident from the market screener also. This P multiple comparison does not make sense, guys. Can you see Zomato का P versus Swiggy का P. There's no comparison. It does not make any sense at all. But when I compared these companies on the basis of sales, I got some sensible comparison, right? EV. So how EV to sales multiple is arrived at? Total enterprise value, value of the entire firm, which includes that part also. We are not discussing EV concept here. Divided by sales. So, guys, can you tell me which company is overpriced? Zomato versus Swiggy. Which company is overpriced and which company is underpriced? Which you should buy? Which is best company to invest? If I am supposed to choose one of these two companies, Swiggy versus Zomato, which is going to create more value for me in future? Zomato is overpriced, right? Deepak and Pankaj, your answer is also right. Swiggy is the right company to invest. Now, guys, see, I've taken the same growth, estimated sales number of these two companies from the market screener. And can you see the difference in growth? 84 versus 34. So market is not doing like, if I just look at the EV to sales multiple, it seems like market is not able to look at there is another company which is highly underpriced. Why market is not looking at Swiggy and why the people are still investing into Zomato where they are paying more than double valuation here? The reason is difference in the expected growth. And guys, if I divide this EV sales with the growth of sales, right? Can you see the result? Are they much different? Do you think EV sales by growth multiple is very much different from each other? Do you think there is a sizable difference in this multiple? Or is this multiple is pretty close? It's very close, guys. So guys, this is how market do comparison and do the pricing. It's very simple example I've taken here, P and sales multiple. And you can see guys, even in the market, there is some logic behind every pricing, right? But it is not just EV sales or EV price to earning. We should also look at the potential, right? So there are other factors also which you can apply in comparison of the companies when you're applying a relative valuation. In DCF, they're totally different approach, totally different concepts, right? But this is how we can quickly arrive at fair valuation of the companies. First, we can understand which company is overpriced, underpriced, and then we can see what is the fair multiple, and this fair multiple can be used to find a fair valuation. So guys, this is what a small concept or small session on the valuation, the smallest what I have ever given in my career, right? So in 1 hour, whatever I could do justice, with the valuation. So I tried to pick these two multiples to make you understand how the valuation works. And we also discussed, first we started with the basic difference between relative valuation and DCF, right? So we discussed briefly what the reason of, difference in the approach of relative and DCF and why we get a different valuation of both the methods. Reason being, both have totally different bases. Then we picked relative valuation and we compared these two multiples, right guys? So friends, that's it for my side for today's valuation session. uh, so guys, any question, any doubt, you can unmute and you can ask anything related to your current role, yeah, or aspirationally, why you want to learn valuation, where you want to apply anything. Okay, guys. So thank you so much, and it was very engaging session. Thanks for being patient, and I think we had a good discussion. Uh, I think window is good. Otherwise, in Mac also you have all the function in of Excel, but yes, there are different commands. Windows works perfect, right? So till now I don't have Mac with me because I'm more comfortable with Windows. All right, guys. Thank you so much. Yes, yes, Ankur, you can reach out to me. Counselor will connect you with me, or maybe you can reach out to the admin team. Okay. All right, guys. Thank you.